The broadcast is now starting. All attendees are in listen-only mode.
Hello everyone, good morning, good evening, and good afternoon, wherever you are. Thank you very much for attending this webinar. My name is Samer. Welcome to Appraising Suppliers' Financial Position. Just like every Saturday noon, we do present a new topic. This time, I thought it would be interesting to go from macro topics in supply chain to more of a selected topics, micro ones, okay? What really inspired this webinar is the previous webinar last week, where we talked about the skills needed to raise the profession in supply chain and the certifications required to do that. So I was thinking of one of the essential skills that everyone that works in the procurement function should possess, actually. Okay, so housekeeping rules before we start. Everyone is muted. This is because of due to the number of attendees. We can't have two ways communication. We have hundreds of attendees coming, so you will remain muted. Whenever you feel you want to ask a question, please leave the question at the chat box. You have a chat box. Just type down your question. I will make sure to dedicate, like every time we do a webinar, I'll make sure to dedicate the last 5 or 10 minutes to answer your questions. Any technical issues, it's definitely beyond of our control, so log off and come back again. It happens sometimes that you lose us, you lose the sound and so on. We will be very sorry for that. It's just the technology issues due to the internet connections and so on. Okay, good. So my name is Samer Al-Madhoun. Just in case you don't know me, I am the managing partner of Muhakat, and I'm a CSCP, CLTD, Scorpi. I am also a SEPS Direct Associate, and I'm going to talk about SEPS shortly. This event is in partnership with SEPS, and we at Muhakat, as a partner of SEPS, we found it very interesting that we share some thoughts on procurement education with everyone who's attending today. And precisely, this session is inspired by the Diploma in Procurement and Supply, one of its books that's called Ethical and Responsible Sourcing. So just a short brief, just in case if you don't know what is the Chartered Institute of Procurement and Supply. We did talk about that in our previous webinar, but you haven't missed much because this time it's more focused. The Diploma in Procurement and Supply is one of the educational levels that's meant to raise certain skills in the procurement profession, one of which is the financial skills and capabilities. So these are the main topics presented at the Diploma in Procurement and Supply, and precisely our topic today, appraising the financial capability of the supplier, is taken from L4M4, Ethical and Responsible Sourcing. Okay, so this book precisely talks about how do we source locally and internationally, and what does it take to create a sourcing function within an organization, and what are the skills that you need to have. One of which among these skills is basically, and this is what I have been thinking of, every webinar that we want to do should raise some skills in you as a procurement professional. So in this hour, the intention is to increase your ability to appraise suppliers using financial measures, meaning you have to have some financial skills as a procurement professional. One of the usage of these financial skills is your ability to appraise suppliers financially. Okay, so before we start, and as always, before we start our session, I would like to draw a poll to see how do we want to base our discussion based on your knowledge in the topic. So I'm going to distribute a poll that asks you about your skills and knowledge in financially appraising suppliers. Okay, simple yes or no. You believe you have the skills and knowledge to appraise suppliers financially. While I drink my tea, I enjoy looking at the polls. So far, very, very promising. Last week, we talked about the skills needed for the procurement profession, and at the level of mid to seniors positions, you should have the financial skills as one of the main skills to build your competency in a procurement function at a personal level. Okay, so to base our discussion, where we want to take our discussion, it's very good to see how you guys rank yourself in the knowledge needed to financially appraise the supplier position. And with the meaning, just in case you don't know what is appraising supplier position, it's your attempt to understand, is the supplier financially capable or not of being your partner. So we have 79% voting so far, 80% voting. So how does the slides going forward look like? We will discuss a bunch of financial measures that you can use to understand the supplier financial position. We'll talk about thank you, Sadaf. We'll talk about the financial measures that can help you understand the supplier financial position going forward. Okay, we'll talk about what we call it pre-qualification process. We'll talk about documentation needed to do that, and so on. Okay. All right. So we have fair enough. We have 90%, and I totally love the results. Pre-qualification questionnaires and so on. Okay, so let's distribute the results, and kind of very exciting to me. This is the first time we see 50% saying yes. That's very interesting. 50% saying no. So what I hope going forward is that you take notes, ask your question. If you are knowledgeable with this, let's take it higher. If you are not, you can ask basic questions. 50% saying yes, we have the skills needed, and this is really great. This is what is really needed from you as a procurement professional, the total understanding of the skills financially on how to appraise suppliers. Okay, so let's go back to our slides. And as you see, this is the skill as needed. So kicking off that with the actual need to pre-qualify suppliers. Today, more than ever, it becomes kind of risky dealing with suppliers without pre-qualifying them. The definition of pre-qualifying is in procurement science and in sourcing process, the pre-qualifying is your attempts to make sure that suppliers fully adheres to your standards that you need to see in a certain supplier. Okay, so basically, as a company working in a supply chain, you want to make sure that your suppliers adhere to certain set of standards that you look in them, and because you have a desired outcome that you want to achieve. And in a supply chain thinking, cross-functionality requires you and your supplier to work in the same boat. Okay, so you start looking for pre-qualification process, and this is a major process in sourcing actually, where you have a set of suppliers that's pre-qualified. Once you want to tender or request bidding and so on, you have those suppliers that's kind of ready, and you made sure that these suppliers adheres to your standards. So I want to determine if my potential suppliers are capable or not for delivering a proposed contract to reduce time needed, add value, and so on. And thus comes the idea of pre-qualification questionnaires that we send to suppliers to make sure that they adhere to our standards. And those questionnaires, the things that you want to learn about suppliers, the things that you need to check about suppliers can range from as simple as, registrations, which means they are legally incorporated, or probably certain experience that they have, health and safety issues, environmental issues, one of which is their financial standing. And with the financial standing, we mean their ability to keep their financials in a healthy situation, because the more the supplier is able to keep themselves in a healthy stand, it means you survive with that suppliers. Because today in a complex supply chain, once your supplier fall, you fall with them. Okay, so it's very important to make sure these suppliers are in adherence to certain set of standards, one of which is the financial standards. Okay? The more you have a robust process of pre-qualifying suppliers prior to dealing with them, the more you are comfortable with the sourcing process, the more you reduce the risk of sourcing and suppliers relations. Having said that, there are many documents that can be used today in the process of solicitation, in the process of bidding, in the process of qualifying and pre-qualifying suppliers. One of the major documentation used today is the request for information. Request for information is non-binding documentation that you share with your suppliers with the attempt to understand certain criteria that you look for. Okay, in an early stage of the buying, you want to make sure that those suppliers adhere to your standards. Okay, and the request for information as a documentation does not maintain a legally binding contract with supplier. It's all about you trying to understand the status of the supplier. Okay, you would be using later on request for quotations or request for proposals, or what we call it pre-qualification questionnaires. Most important, I would say, the RFI and the pre-qualification questionnaires will make you understand prior to sourcing process, prior to bidding process, prior to tendering process, will make you understand the situation of the supplier. So you may wish to maintain a list of suppliers, an approved suppliers list of those suppliers that's already qualified. And these suppliers will serve as ready suppliers to contract with, just in case if you want to. And this will reduce the time needed, will reduce the complexity, will reduce the amount of risk that might be inherent in the sourcing process, especially when you do international sourcing. Okay, so let's have a look at a request for information document, a standard one that I get from SIPS. I downloaded today from SIPS website, so you can download yourself. Something to share with the supplier, request for information. These documents can be sent to suppliers, and as you see, what can you request from your supplier ranges from confidentiality to supplier details, supplier financials, supplier awards, policies of the suppliers, everything can be requested from the supplier about cost of items and so on. And if you go down the document, this is just a generic document. If you go down to page 9, you will find that the last page talks about supplier financials. As you see here, it's no shame, and it's completely legal that you request suppliers to share their financial with you. Okay, details of suppliers' financial background, annual reports, latest financial statements, insurance of the suppliers, market share, turnover, revenue, volume outputs, and so on, funding arrangements that they have, kind of credits that they have with the banks, opportunities, loans, and so on. It's totally legal and totally legitimate and non-confidential, by the way, that the supplier would share their financial figures with you. I know everyone's asking, does really supplier accept to share their financials with us? They should. I know companies today that they make the sharing of financial information as a prerequisite to identifying suppliers at their systems as a potential supplier to deal with. Okay, so suppliers tries to hide behind things like this is confidential figures and so on. I'm going to talk about this later towards the end of the webinar today. Okay. So now what? What is the importance of looking at the supplier financial stability? Okay, there should be a due diligence. Due diligence is what we call it today, your attempt to drag this data, analyze this data, to make sure that the supplier is fit for your culture, for your needs, for your requirements. Okay, so that's why we need to look into the financial stability of those suppliers. I need to make sure, is the supplier in a certain point of time able to invest with me? Sometimes we need to have high capacity at the warehouses at the supplier end because I want to store the material at the supplier end. Sometimes we need to integrate systems with suppliers. Sometimes in some collaborative arrangements with suppliers, we want to have suppliers investing on new resources like machines and so on to cope with my needs, demands, and so on. Okay, I want to know through the due diligence and the financial stability, how much is the supplier dependent on the buying organization? Okay, because some suppliers like to play it smart by totally depending on the buying organization, by requesting, sometimes requesting advance payment and so on. We'll talk about that later as well. Okay, all in all, your ability to check the supplier financial stability is a risk management approach. Especially through the hard times that we are going through and going forward, you want to make sure that your suppliers are in a good stand, because in a supply chain, in a complex setup of a supply chain, when my supplier fall, I fall with him. Okay, so I want to make sure that these suppliers are healthy from a financial standpoint. So what do I look for? What kind of measures do I need to see in the supplier to make sure, and how do they look like, and what is ideal for me? So let's dig deeper into that. What is ideal for me and so on. There are three main measures, three important definitions, and you use them as ratios to see the supplier financial solvency. Is the supplier able to stand the market or not? Okay, these measures should give you an indication on the supplier situation. The first is the profitability that the supplier is achieving. And profitability is really profitability. Is the supplier making profit or not? How does his revenues look like in relation to total cost? This is something you want to examine given the supplier financial info. Okay. Liquidity, another great measure that you need to look at. And basically liquidity shows the solvency measure of the supplier. And does the supplier have cash enough to survive businesses or not? And this is where you need to look into the liabilities of the supplier in relation to the assets of the suppliers. Liabilities, what a supplier has to pay, and the assets that can be liquidated to generate cash to those suppliers, and the relation between them would show you liquidity measures that you can judge to see if the supplier is in good financial position or not. You can look at the gearing ratios, and gearing ratios is a very simple format. How much of the supplier business is being funded by debit? How much of the supplier business is being funded by debit? Okay, so basically you look for, is the supplier profitable or not? Is he making profit or not? Does the supplier have enough cash to survive the business? Liquidity. Is the supplier funding their business through debit or not? All in all, you need to protect yourself from the supplier solvency, where the supplier shut down the business and you find yourself stuck with a supplier that does not supply any more material because they went outside the market because of the insolvency issues and the financial issues that they are facing, especially in the current situation of the outbreak and going forward. You want to make sure that, I know all companies are shaky today, but going forward, you want to make sure that the suppliers are capable to stand issues at least in the short term. Okay, so what we want to do going forward is to check the profitability, liquidity, and gearing throughout the slides, and take a simple example and to see how the supplier one supplier look like from a solvency standpoint. Okay, in order to do that, in order to calculate the ratios, liquidity, gearing, profitability, and so on, you need to look into financial statements. I know not everyone is comfortable with financials, not myself even. But the thing is, as a procurement professional, you need to raise awareness of the financial thinking. So all these figures that we looked at, liquidity, profitability, and gearings, basically are dragged from suppliers' financial statements, or I would say supplier financial figures. So just in case you don't know, there are three basic financial statements. The first is the statement of the income, profit and loss. The second is the cash statement, and the third is the balance sheet. Okay, and we are not going to dig deep into the components of these statements because we don't have time. You need to educate yourself about these, but the main issue here is not educating you about the financial statement, but rather the measures that you can use from the financial statement. Okay, so the first one is the statement of the income, and this kind of statement will show you basically for your company or for your supplier, did we make profit in a certain point of time or not? How much did we sell minus the expenses that we have, so we end up with a net profit. So the elements of this financial statement will be used to calculate some measures that shows the supplier financial position. Cash flow statement will show me how much my company or my supplier would have cash as liquidity to start new projects, for example, or to pay salaries and so on. Balance sheet will show me the strength of any company by showing the assets and the liabilities. What does the company have, and what does the company liable for and need to pay for the suppliers, banks, and so on. So having said that, these three financial statements, among other measures, will show me how to calculate the financial situation of the supplier. Okay? This is an example of the balance sheet for one company. As I said, I'm not going to dig deeper in educating you about the financial statements, but the balance sheet will show me the assets and liabilities of a supplier. For example, you can see that this supplier is worth 120 million and having liabilities, things to pay for their suppliers probably, and so on, 70 million. And I can also see that these guys have a certain amount of inventory, 50 million, and that amount of uncollected cash, 55 million. And this is the amount that they make, the equities, and the money they spread for their shareholders and so on. For example, they distributed 100 million for their shareholders and they made profit that's equal to 50 million, and so on. I can see also my fixed assets, long-term assets like machines, buildings, whatever, factories, and so on. And I can see the total liabilities that they have to pay. They have to pay at a certain point of time 200 million. And the bottom line here is that the total assets should be equal to the total liabilities. The total assets should be equal to the total liabilities. However, as I said, I'm not going to dig deeper in this, but we'll make sure that we use some of these elements in the financial statement as the total liabilities. We want to make sure that we use some of these elements to calculate the supplier financial situation today. Okay? Good. So going back, we need to look into profitability, liquidity, and gearings. So let's do a fast tour in every one of them. Profitability ratios is very classic. This is where you want to see, is the supplier making profit or not? Is the supplier making profit or not? And this is definitely, if the supplier is making profit, that should be somehow a good indication that this supplier is living a healthy period of time. So you want to make sure you look at things like gross profit, which basically means what is the initial profit that this supplier is making. So you want to look how much did they make profit and compare it to the overall sales they have. You might be, or you may wish to look into the net profit margin, how much in the bottom line they make profit. Then you would compare the net profit of the organization to the sales revenue that the organization is making in relation to each other. And all of these measures, gross profit, sales revenue, net profit, and so on, can be directly taken from an income statement. You may wish also to look into, for example, there are many measures, return on assets. And return on assets talks about how much the supplier is making profit in relation to their assets, and so on. So you can do simple calculation by understanding or requesting or having the gross profit of the supplier in a certain period of time, let's say 2019, the total sales revenue of the suppliers, the net profit of the supplier, put them all together in a gross profit margin and in a net profit margin, and see how much the supplier is making as a percentage of their business, how much do they generate revenue. Definitely the higher the gross profit margin and the net profit margin and the return on asset, that would indicate that the supplier is somehow making profit, and this means that the business is flourishing for that supplier. Okay, if these measures are low, this means this supplier is not making profit. And when the supplier does not make profit, there is a great chance that this supplier will just leave the business out of a sudden, saying we are not making profit anymore, we want to close the business going forward, and so on. So recently we have seen companies in Lebanon, for example, sadly brands like Coca-Cola in Lebanon is closing, and definitely because the gross profit margin going forward and net profit margin and other many reasons, the cost of material and so on is soaring, and this as a supplier, then they have issues for payments and so on. Okay, so let's have a look into sample of these measures. Okay, so as said, we say that the gross profit margin is as comparing the relationship between gross profit and sales. So this company, for example, if we look at the supplier financial statement and we see that the gross profit, which is the initial profit after deducting the cost of making things, the cost of goods sold, they had been making 52 million is a gross profit in relation to selling 209. Okay, so if you just look into this company, you find that the relation between them is 24%, 0.5. Good or not good, this is something we will look at later after we look into different measures. So this company is making 25% as a gross profit. Sounds like a good business to me personally. I would love to make 25% plus on that. Okay, so if you look into this measure and you find the relationship between the two figures is very low, like let's say this supplier is making like 5% as a gross profit margin, this is a dangerous indication because the supplier is not making a lot of money, and this might leave the supplier with less cash, and he cannot survive hard times like the hard times we are in today. Okay, so this is one great profitability measure to look at. You may wish to look at the net profit percentage, and as simple as this equation, you need to look at the profit before taxes in relation to sales. Okay, so I'm looking at the net profit in relation to sales. So this company made, let me go back. Initially, this company made 52%, 52 million as initial profit, but not final profit. And now when we go to see the final profit, we see that they make 25 million as net profit in relation to the overall sales they have. Okay, so it makes sense to us that the figure is lower here because we are looking at the net profit, Safi. So this company is making 12% net profit as part of their operations, meaning out of selling 200 million online, they generate 25 million, and that means 12% of sales is net profit. Good or not? For sure, the higher the better. The higher the better, the lower the worse for these suppliers. The lower the worse for these suppliers. So this is two great measures to look at when it comes to profitability. Very simple, very straightforward. Okay, and I know everyone is thinking now, where do I get these measures from? I'm going to delay this discussion towards the final slides actually. Okay, one great measure for profitability is the return on assets, and the return on assets basically asks the major question: how does the company investment in asset look like in relation to the profitability that they make? Okay. How much the company profitability look like in relation to the assets, profitability in relation to their assets. So the more they invest in assets like factories, fleets, warehouses, machines, and so on, do they generate more profit or not? What is really ideal is you operate with the total assets that's low and the highest profit possible. يعني making use of the lowest asset to generate the highest profit. Okay, so given this equation where you need to see all your assets, أصولك, currents and fixed assets in relation to your operating profit, this company, the net profit for this company is 27 million. Okay, and the assets of the company, long-term and short-term assets, are equal to 200 million and 4. In relation to each other, the assets is 13.2%, meaning when they invested 200 million in their assets, factories, machines, warehouses, they could generate 27%, and that counts for 13% of the asset value. For the 200 million they invested in assets, brought back 13% more money to the organization. Okay, is this good or bad? Definitely, the higher, the better is the figure. Okay, what is ideal for an organization? This is something to discuss towards also the end of the class as well. Okay, so again, we did 3 profitability measures so far. We looked at the classic, simple and straightforward. We were talking about the profitability. Okay, is the company making money or not? So we looked at gross profit margin, we looked at net profit margins, and we looked at return on assets. Let's do more. So this is 3 basic measures you want to look at as a procurement professional to evaluate supplier performance. Let's do some liquidity ratios. Liquidity means availability of cash to survive business in a simple format. Okay, so you want to see how is the company performing. How is the company performing when it comes to their assets and their liabilities? الأصول والخصوم. Assets is basically how much you own, and liabilities how much you want to pay. And when we say current assets, this means short-term assets and short-term liabilities. So the first basic ratio you want to look at in liquidity to see if is the company having a proper financial position to stand its liabilities. So usually suppliers has liabilities. They have to pay their suppliers. They have loans to give to the banks and so on. Okay, they have bills to pay and so on. So does the company have what can be liquidated as an asset like inventory, receivables, and so on in relation to how much do they have to pay? Okay, so how much they are owning versus how much they have to pay. So this would form the first ratio, which is basically the current ratio. Okay, one of the elements of the current ratio is the inventory. Okay, so inventory can be deceiving. Maybe we have too much inventory, and that would give a great current ratio, very high one, but that does not mean the supplier is in a good position. Why? Because maybe the inventory they have is a dead stock or slow-moving item, which means it cannot be liquidated to create or generate cash for the organization, and thus they cannot use these figures to pay their liabilities. So another measure comes, which is called the asset test ratio, and all it does is using the same equation of the current ratio, but with this including the stock or inventory value that you have, to see exactly how do you perform without your inventory, because there might be a chance that your inventory is slow moving. So if it is slow moving, this figure becomes deceiving for the organization. Okay, good. So let's have a quick look on current ratio that you need to calculate for your supplier, and asset test ratio. Both of them are liquidity ratios to show you the supplier ability to meet his liabilities. If the supplier is unable to meet his liability, this means you are in a great risk that the supplier might shut down their business because they might go out of business because of inability to pay their liabilities. Okay, so both measures, as you see in the description, looks at the ability of the supplier to pay their short-term liabilities. Okay, so where do I get these measures from? Like current assets and current liabilities and inventory value and so on. This is back to the just to connect you to the financial statements. As you see here, we have current assets of an organization, we have current liabilities of an organization, we have inventory values in place and so on. I'm going to use these measures to see how does the supplier perform in relation to their liquidity. Okay. So short-term liquidity, how do they look like? As you said, the current ratio, basically current asset versus current liability. And this company, for example, has 74 million of current assets in relation to 46 million on liability. And this is initially looks good to me. Why? Because they have more assets than their liabilities, which means they can liquidate these assets like inventory, receivables, to pay these liabilities. And once they do, they still have more money to play with. So this supplier looked maybe fine to me. And the ratio here, this is a ratio. It's not percentage, it's nothing, just ratio, 1.61. 1.61, higher than 1, which means they have more money than they have on liability. But as I said, this might be deceiving because this figure includes inventory, and inventory might be a value of assets, but it does not necessarily liquidate because it's slow-moving items, or you might have stocked with too much assets that's the wrong inventory that's not going to be sold and so on. That's why you need to look into the asset test ratio, which basically disinclude the inventory value from the calculation. So this company, once they disincluded the inventory value, very interesting. The current assets drops down from 47%, 74 million. Sorry, guys. It drops from 74 million to become 32 million. So now, excluding the inventory from the equation, things are not good at all. Maybe because they have what can be liquidated that's worth 32 million, but they have to pay 46 million. So the ratio here is 0.7 in relation to when we include inventory as a value in this case. Okay, good or not? Just give me 5-10 minutes, and then we see together how good are these measures for the supplier from an international standpoint. Okay. Gearing ratios. So we talked about, let me go back. We did the profitability ratios and liquidity ratios to see, is the supplier making profit or not? Is the supplier having enough cash to survive liabilities and businesses or not? The gearing ratios, the last one, is about showing me how much of the supplier money is being funded by debit. Okay, so this is what we call it gearing ratio. And as it says, the gearing is a statement or measurement of how much an organization long-term funding, the money they have on the long term, is represented by long-term debits. Meaning the cash they have today is because they have debits to the banks. Okay. And a lot of suppliers like to play this game where the majority of the cash they have it from the banks, actually, not their own money. Okay, good or bad, we need to look into this going forward. But here is how the simplest form of gearing. You see, I love this definition. They are straightforward. The material is taken directly from SEP's box, by the way. It's the proportion of the organization borrowing, how much they borrow in against how much cash and equity they have. Okay, so the simplest format is to look at the long-term debit, and this is also something you get from the balance sheet as well. You look into the long-term debit in relation to how much they, I would say, give equity to their shareholders. يعني يوزعوا فلوس وأرباح وقيمة مالية, financial standpoints for their owners and company owners and so on. Okay, so in a simple format, if you look at the how much time you have long-term loans in relation to the how much you spread money, the equity of the company. So this company has 40 million of debits. So the business is funded by 40 million on the long run by debits, but they have equity money spread to the shareholders and net worthness of the company that's worth 180 million. And that would return a gearing ratio of 33.9%. Okay. Now, how do we perceive this figure, the gearing ratio of an organization? Okay. A high gearing ratio means that there is a lot of long-term debt with the company, which may present risk in the long term for that supplier to deal with. While a low gearing ratio means that an organization is relying on the equity as a capital. So they fund their business by their own money and should therefore have less difficulty coping during tough economic times because they have money and they don't have much to pay for the banks and so on. Okay. We'll talk about this as a strategy. So some companies have strategies to finance their business through debits, and that's totally okay. Okay, and this will take us to the last slide where we discuss these measures. So these guys, from a gearing ratio, they have 33.9%. High or low, we will judge this shortly. Okay. Another great measure that you can use away from the profitability, liquidity, and the gearing ratio is to look for things like inventory turnover, for example. And inventory turnover tells you exactly how much the company, how is the company efficiency in managing their money in inventory. How much is the company efficient in managing their money in inventory? How many times did the organization flip their money in the inventory? The higher the better, because the more you flip your money in the inventory and the inventory goes out to be sold, and then you bring money again and you buy inventory and then you sell that, and then that generates profits, and you keep doing this over a year. The higher the number of times that you flip your money in an inventory, the healthier the business becomes. Okay, so for me, a high inventory turnover or stock turnover ratio is a great thing. A low one is a sign of financial difficulties that the supplier is facing. Okay, so in this case, when you look at the cost of sales in relation to average stock value that they have today, so this company has a worth of money of 157, and in relation to their stock, shortly this says they flipped their money inside the inventory 3.6 times. Good or not, I can't tell you. It depends on the organization business, but as far as I'm concerned, the higher the inventory turnover, the more healthy the organizational capability to bring money, because it means they flipped their money in the inventory almost 4 times in a year. Okay, if they flip more, it means that the company have more liquidity and more cash, and the business is healthy, and so on. Okay, so what did I do looking to all these measures? Now the question becomes, is this good or bad? Like 33.9, 1.61. I don't want to get lost with all these figures, or probably 13.2. Are these good or bad? So I assembled a best practice for you. How does an ideal ratio look like? This is a table taken from SIPS diploma, talks about the ideal ratios that you would love to see in your suppliers. For example, gross profit margin. What is an ideal is that the supplier achieve above 20%. Return on assets. What is good is that the supplier would have anywhere over 5%. Current ratio, the one that shows the supplier relation between liabilities and assets, over 1 is great. A gearing ratio, how much is the supplier funding their business with long-term liabilities? Under 50% is great, and so on. Then I took all the measures that we did today in the example, and I compared them to what is an ideal. So my question to you, how do you see the supplier performance? The supplier had 24.9% in a gross profit margin. which is higher than 20%. The supplier had 12% net profit margin, less than 15. The supplier has a return on assets that's 13.2. Our good measure is 5, so he's doing great in this measure as well. And we did the current ratio, for example, and a good current ratio is somewhere over 1, and our current ratio is 1.61. We did also the asset test ratio. We are somewhere below 1. We looked at the gearing ratio. Ours is 33.9, and what is ideal is under 15. So it looks good here. It looks somewhere good here. It looks somewhere good here. From a financial standpoint, this supplier looks healthy to us. From a financial standpoint, from a pre-qualification standpoint, this supplier looks healthy to us, and it seems like this supplier is flourishing the business more or less. I should not fear that the supplier might be going into financial difficulties that would risk my supply chain, and that's really great. This is what we look for in a request for information in a pre-qualification process and so on. So now what do we do? The supplier is in a good financial stand. Does that mean everything is good with that supplier? Definitely no. You should not, I'm going to talk about this shortly, you should not take the financial measures as an as-is to say yes, no with the supplier. Before we finish, we look into this further, one great measure that I always love to calculate for my suppliers is called the Altman. So a scientist called Altman developed a Z-score formula, and this Z-score formula, what it does basically, as you see, it's just complex, huh? So I'm not going to talk about the components. It also drags elements from the financial situation of the supplier and the financial statements like working capital, total assets, same, sales, and so on, and put them all together in one equation, and then you look into the results. If the results is somewhere greater than 2.6, the Altman Z-score, it means that this supplier is healthy and is not facing financial issues. If the measures is less than 1.1, this is a red flag for you that this supplier, it's a matter of time before it goes outside the market. The supplier will bankrupt at any point of time because of the relation between their assets, sales, retained earnings, and so on, coming all together. Okay, so Altman Z-score is very important to you, and I know everyone is wondering now, wow, do I have to calculate all these and learn? No, not really. I'm going to tip you about that shortly, but let's do a simple exercise on an Excel sheet. So let me enlarge that if I can. Let me see. There you go. So these are the elements of the Altman Z-score: total assets, total liability, total equity. Let's do this randomly. Okay, so these guys are having total assets worth 100 million, total liability 230. I'm just giving random figures. Equity of 2 times returned earnings by 132, working capital 321. EBIT, earning before interest and tax, 92, whatever, just randomly. Sales, 100 million. Okay, so randomly, this supplier has an Altman Z-score as a ratio 10.38. So going back to our slide, and we see that, so our numbers were very inflated, but it's anyway higher than 2.6. Higher than 2.6. This means this supplier is in a good financial stand because this is a green alert. The supplier is physically, financially sound. Okay, physically and financially sound. This is also very interesting for you to look at. Okay, good. Let this presentation and webinar sparks ideas for you. How should you do this going forward? Okay. By the way, internationally, there are what we call them today credit rating agencies, and credit rating agencies are international associations that will help you to rate your supplier financial health, and these agencies, they assess financial stability of an organization. You pay an annual subscription to them, and they would assess suppliers to you, or they would show you suppliers in certain categories that's financially assessed already. So they would do the pre-qualification, the financial pre-qualifications in your behalf. In this case, they look at the payment history of the supplier, the credit mix, the new credits they have, the length of the credit history, the amount owed by an organization, and so on, and they come back to you and they send you a consolidated report about suppliers. Okay. Now, how do we treat the results of all these financial measures? Despite the fact that they are great and they give me great look at the supplier financial stability, I don't think you should take them as black or white. I don't think that you should take them as black or white. You need to look at different measures in pre-qualifying suppliers, but take the financial position as an important factor. You need to look at the innovation of the supplier, you need to look at the value that the supplier will add to you, how much you need that supplier, and so on. So you maybe wish to build a risk management plan against those pre-qualifications. Let me give you an example to make this more clear to you. So the majority of the things we looked at today looks at the debits of the organization, looks at the assets of the organization, how much do they have assets, and so on in return. So greater assets is good because they will pay their liabilities and so on. Let me share with you a case from my experience. A company like Uber is the greatest supply chain of transportation today, but they have no assets. So when you evaluate their financial statement, you don't expect to see huge amount of assets they have to pay their liabilities. Okay, that doesn't make them insolvent suppliers. Aramex, for example, they made two great business strategies. One of them is to operate without assets as well. So the majority of the fleet that Aramex has, the third-party logistics provider, the majority of the fleet they have, they don't own it, they lease it. So in that case, it doesn't go into their financial statement as assets, fleets, and so on. So you wouldn't see these huge figures for fleets they have, like gearing ratios and so on. Might not be viable for that. Also, Aramex's strategy is, and this is something I learned from Mr. Fadi Ghandour himself, the owner, is never to finance the business by your own money. Always go to banks to finance your business and you can make your profit. So in this case, they do have long-term debits in relation to their current profitability and so on. Okay, so what I'm trying to tell you here is that you just don't go black and white looking at the figures. Try to consider other factors like the company strategy, for example. Okay, so if you see the gearing ratio very low or very high for Aramex, you should also consider how Aramex is working as a supplier to you. Okay, or Uber, for example, if you see that they don't have liquidated cash from their assets, that's normal because their strategy is to operate without assets. Okay, so please take these measures, but incorporate them in a bigger thinking about the value that the supplier will add to you, how much you need that supplier, and the capability of those suppliers, and so on. Okay, now some tips. Every time I discuss this with procurement professional, I hear some complaints about it. However, can I look into other measures from a financial standpoint? Yeah, rumors about the supplier financial situation, something to investigate. Supplier requesting advance payment, always something to investigate. The banks, the supplier keep changing their banks, this is something to investigate. Staff turnover very high at the supplier end, something to investigate from a financial standpoint. Okay, because you know very well, if your company is not in a good financial situation, you will make sure that you leave, or probably they would ask you to leave eventually. So when you look at these things into the supplier, they would give you an indication on the supplier situation, and this is something to investigate as a procurement professional. Now, how do I going forward? You don't have to be an expert in finance or financial management to do that. You may do two things. Work hard, have an Excel sheet where it has all these figures and pre-programmed, and maybe you would like to ask the financial department at your organization or anyone that has finance experience to build an Excel sheet for you to look into these figures. Okay, so build an Excel sheet, have someone from the finance department helping you, but the skill that you need here is to be able to judge the figures as a procurement professional. Okay, always request the supplier to submit financial statements. I know you guys have question mark over that, the supplier is not willing to submit. Make this legitimate dealing with the supplier. Okay, And by the way, I've always worked in companies that request the financial statement of the supplier as part of the pre-qualification process for that supplier. Supplier is not willing to share, saying it is confidential information. This supplier is hiding something. Tell the supplier, I'm willing to sign non-confidentiality agreement with you to see these figures. Okay. Supplier is stubborn, bigger than you, does not want to share financial statement. Okay, don't share financial statements. Just build an Excel sheet where it says, please fill in total assets. Please fill in total liabilities, and that's it. I don't want to see your financial statement. In the worst case scenario, okay? Build an Excel sheet, share it with the supplier, ask the supplier to fill these figures for you without having the financial statement going forward. Okay? I think that's it for now. Let's do the questions. I see a lot of questions coming forward, so I'll do my best to answer them all, so please be patient with me. Abdullah is asking, is it possible? Please keep your questions coming. I'm going to answer them. Abdullah is asking, is it possible to get video link for the last week webinar? Of course, Abdullah, it was uploaded to the YouTube page. All webinars are uploaded to the YouTube page. Sadaf is asking, okay, welcome Sadaf. Pre-qualification question is, yeah. Is there any technicality and commerciality capable of providing service based on the required specification? Sadaf, I'm not following, so please rephrase your question. Many suppliers will reject, Abdullah and Sadaf are asking, many suppliers will reject to provide their financial standings such as balance sheet. Kindly suggest some solution for that. Abdullah, as I said, I hope I answered this already. 2 ways to do that. If the supplier is, by the way, in the public companies, it is required to be published at the newspaper. So there's no secrecy about that. If the supplier is not willing to share, this means the supplier is hiding something. Okay, in this case, build an Excel sheet and do not ask for try to trick him by not asking for the entire statement, but rather filling total assets for you, total liability, to try as much as you can. That's a great challenge, by the way, to get an idea about the financial standpoint. Anything about complex context during crisis where financial statements are not available? Yara, it's always available and can be shared today. Okay, all companies you know why, Yara, the financial statements are available, because it's mandatory by the auditors. This is how financial statements started, by the way, because the auditors wants to come at the end of the year or at a point of time and see how the company is performing. So what I want to say here is that financial measures is always available for the company, Yara. Yeah, Sadaf is saying we can use non-disclosure agreement. Exactly. Before RFI or before requesting these, tell the supplier, I'm going to sign for you a non-disclosure agreement. Yara says they publish them online, of course, for public holding companies. Abdullah asks, when can we waive this requirement, financial statement? If you mean when do we ask for them? In the pre-qualification process, where you want to make sure that the supplier is fit for your requirements. How can we do supplier assessment? Please provide examples for high-risk suppliers and medium-low risks. Abdullah, I would rather have a dedicated class for risk management that talks about the matrix of high and low risks and so on. Hania is asking, would you please explain the difference between supplier qualification and supplier appraisal? They are used interchangeably. Sometimes companies use pre-qualification and sometimes they use supplier appraisals. Most important for you is to differentiate between pre and post evaluation. Pre-evaluation are both what we call them supplier pre-qualification and supplier appraisals, while the post-evaluation is just based on the performance of the supplier after you deal with them on the long run. So maybe sometimes we call the supplier appraisal, Hania, as the post-evaluation. Sadaf Fatima is asking, the norm is to look at the financial statement for 3 years. Haven't really requested balance sheet with any suppliers. Why don't you do that? It's okay to look at these figures. You can do this by historically for 3 years. You know, this is funny. I knew a company that always requests the financial statement of the supplier, but they never analyze anything there. Just they want the supplier to submit financial statements, and actually you want them to submit in order to take an action on that. Why a supplier with low score on financial ratio? It may not be linked to poor performance. Yeah, I agree with you, Hania. As I said, Hania, the financial measures are not the only measures that you need to look at. It might happen, as I said, in the case of Aramex and the case of Uber, that you find low assets or high debits, but that does not make the company in a bad situation, Hania. Okay? Okay. I am Uber. Abdullah is asking, I'm surprised that Uber announced losses globally. I don't know about that. Really, I don't know. But this is interesting to know, Abdullah. Okay, Abdullah is asking, I always ask suppliers for Aramco and SABIC vendor numbers as references, which will mean they went through the pre-qualification process. This is amazing, Abdullah, because Aramco and SABIC have done tremendous job in evaluating and pre-qualifying their suppliers. So yeah, if you ask a company for their registered number as a supplier for Aramco or SABIC, that will do. That will be great, actually. Jamshid is asking, what kind of information do we translate from supplier liquidity ratios? If the liquidity ratios of their business it is all over, whether they can pay or not, none of my business. No, it is your business, Jamshid. If they pay, if they have an ability to pay their debits, it means they can survive the market. But if they can't survive the market because they don't have money to finance their business, they would just email you that they are closed and they run out of business. So it's your interest, Jamshid, to see if the supplier is able to pay their debits, actually. Okay? You want to reduce the risk on yourself. Asma is asking about the courses. Tamer Ali, could you please provide me slides as well as the Excel sheet? The slides will be made available through this webinar at the YouTube, Tamer. The Excel sheet, no, for one reason. It's not copyrighted at all, it's mine. But what I want you to do is to work hard to build your own. The best way to learn this is to work hard to build your own once and forever and for every supplier, okay? I asked myself this question if I want to share the Excel sheets that have the measures and so on. I think it's the interest of everyone that they build their own with the help of the finance department. Abdurrahman Jarar is asking if a CFO would typically view the inventory turnover metrics to assess which of the following: financial performance or liquidity. That's a good question. The inventory turnover will show you how efficient are you in using your assets. Okay, so in this case, liquidity is part of this, because liquidity is about showing your assets versus liability, the asset test ratio and the liquidity and so on, and also financial performance. I see the inventory turnover as a helicopter view of the company financial performance, because it shows they have more liquidity, more cash, healthy situation, and so on. If you notice, Abdullah, I did not include inventory turnover any one of the three measures. I put that in a separate slide, actually. Junaid is asking, can you please share the RFI document from SEPS? Yeah, because this is a SEPS document. I would love if you go grab it from there. Otherwise, I would love to share it with you, Junaid. Lana is asking, does the RFQ enough to deal with suppliers? No, Lana, because request for quotation is a documentation to request bids from the suppliers. So no, it's not enough. We had been talking about supplier pre-qualifications and suppliers request for information and so on. No banking systems, Ziara, that's bad. Sadaf is asking, I was thinking while listening to you, it was really great. Thank you, Sadaf. Khalid is asking, I think the process should be repeated every 3 to 5 years. Yeah, Khalid, I missed. Khalid Isa is asking, the process should be repeated. Yeah, I missed talking about that, actually. You want to make sure that the supplier is still viable financially. I know a company that measures the Altman ZScore 3 times a year to see is the supplier performing well or not. The Altman ZScore, to see are they above 2.6 or less, to take measures if the supplier at any point of time goes below 2.6. Anas Sassi is asking how to link supplier solvency to the supply chain resilience. So solvency is about leaving the market, and resilience is about moving fast. The higher the solvency of the supplier, the higher the risk that you are at, Anas, and the lower the resiliency that you have. Again, the higher the supplier insolvency and the inavailability of cash at the suppliers, the less the resilient you become because of your suppliers, because the supplier would go down and you would trigger problems that makes you less resilient. Sadaf is answering one of our colleagues saying that supplier appraisal is post. Yeah, I agree with you, is post process in this case. Alwani, Abdurrahman Alwani, how can you attend SIPS exams for this part? Abdurrahman, this is part of a bigger program called the Diploma in Procurement and Supply. So basically there's no examination for this appraisal, financial appraisal session. Hussam Najjar is asking, is it possible to get all the financial information from the supplier external auditors? No, because the supplier external auditor signs a non-disclosure agreement unless the supplier forwards that to you saying, go take this from the auditor, but basically the auditor is not the source of this information, by the way. Speaking of audits, some asks me, would supplier manipulate their financial statements? Of course they would, to make it look healthy. So what can you do? Ask them to have it stamped by their auditors. Okay. Abdurrahman, sure, Abdurrahman, most welcome. Okay. Ahmed Khalili, we need to be careful if the financial statements consolidated, especially if we are dealing with just part or branch of the company. Yes, you have to be careful with that. It's up to you to see the bigger picture, like looking at the mother company performance, Ahmed, but it's okay also to look at the local branch capability. It depends. What is your purpose? At the bottom line, your purpose to see if the supplier is in good stand or not. Okay. Rami is asking how many points I should take balance sheet and income statement to evaluate. You need to elaborate more, Rami, because I did not get your point. Ali is asking, we are talking about assets versus liability. Does that mean the company can sell their assets to settle their liability? Yes, it means that they can liquidate cash from their short-term assets. If they do so, then they will not have the required assets to produce or continue their operations. No, we have to differentiate, Ali, between short-term assets and long-term assets. Short-term assets are just like inventory and cash they will receive from their customers, okay? And this is the one that we look for. For the long-term assets, we did not look at any measures in the liquidity that perceives long-term assets, okay? We only talked about the quick ratio and the asset test ratio, discuss basically short-term assets that can be liquidated anyway, like inventory they have, for example. Okay, last question. Elias, most welcome, Elias. Let this, Elias, trigger more learning in the financial skills that you need to raise in yourself. Maher Al-Utayb is asking, what about the Excel sheet of the calculation? As I said, Maher, I want you to do your own, and I will be happy to assist you with that. Inventory turnover, Abdurrahman Jarrar is asking, so inventory turnover, we can consider it under activity ratios, financial performance. I did not think of that. It is a financial performance, but not the activity ratio one. The inventory turnover is a holistic helicopter view of the inventory efficiency. So it's not an activity ratio, okay, at least to me. Welcome, Hania. Thank you for your efforts. Rami is asking, I mean, how many statements and balance sheet should I request for last 3 years? Well, the income statement is about how much did you make income at a point of time. So you can ask it for 2019, 2018, 2017, and try to see the relation between liquidity and assets and liabilities between 3 years, for example. So you may wish to ask for 3 years if you want. You may wish to look at the last year as a standard for you. Okay, so we're perfectly on time. That's it for the questions today. Thank you everyone for attending and listening. through these times. Again, if you have any questions, my pleasure, everyone. My pleasure. If you have any questions, send it to info@muhakat. You will receive a certificate of attendance, and you will receive also, you will have it, you have this webinar uploaded at the YouTube page, and so on. Thank you very much. I think we have a last question coming from Yasser Badawi. Yasser is asking, thank you, Samer. All measures were highlighted during the webinar are great. Yes, of course, dear. Service, but in such force majeure, yeah, today is force majeure. I totally agree with that. So maybe if you look into the measures, try to look at 2019, 2018, 2017, just to get a feel about the supplier performance, Yasser. But today, in the current situation, I know it is shaky everywhere. I know that. But that would be interesting to look at how the COVID outbreak affected suppliers when you look at these measures. And this is an amazing learning. I would love to do that with a supplier today, to see 2019 versus 2020, how were they performing and how are they performing now in relation to the COVID outbreak. Okay, great point, Yasser. Exactly that. Some companies run light assets strategies, so it will end up missing inputs to determine measure like gearing ratio. Yasser, you wanna, as I said, you need to investigate further. When the figure looks very odd, you wanna make sure that you understand the company strategy, like Uber, Aramex, and others, that they want to operate without assets. Okay, so if you find the figures very black, go investigate further about the way, ask the supplier in the request for information about the way they operate and so on. It's okay to talk to the supplier about these figures as well. You know, today is all about supplier collaboration. Thank you very much, guys. Jazakallah khair kulkum. Yes, sure, man. Basically, Maher is asking about the YouTube. It's just muhakat. You know, go put muhakat, and you have all the webinars that we did in the last month, and this one starting tomorrow or the day after. Excellent. Thank you very much. It was my pleasure as always, and I'll make sure to think of next week webinar, next Saturday if we have one, and I'll make sure to publish that for everyone. Until then, stay safe, and thank you very much for your time, and we look forward to seeing you next week. It's always a pleasure to have you. So next week also we'll look into something micro maybe to discuss in logistics or supply chain. We'll see about that. Always keep the flame of education in your heart, guys. It's always great to build skills of supply chain. Last week we talked about the gap that we have, you know, in our skills, and this is the shortening of talent is an international thing, and we have a talent gap that we need to bridge. So keep on learning, read books, Google it, go to SEP's website, attend classes, whatever you want. Okay, thank you very much. Thank you, Maher. Thank you, Noor. Everyone, thank you, and we look forward to seeing you next week, inshallah. Thank you, Sadaf. Sharaftuna, guys. Thank you, everyone. So I'm gonna end this seminar and see you next week. Bye-bye. Great. End webinar.